So imagine an economy where unemployment is noticeably rising, debt is rising significantly relative to wages, production is declining, and stock prices are well above what they are actually valued at. Now at this point you may say, well Daniel, it sounds like you're describing what's happening to our country's economy right now. The truth is, this is exactly what was happening leading up to the worst economic crash our country has ever seen. You see, between the years of 1920 and 1929, our nation's wealth more than doubled to the point where our economy was expanding so rapidly that this era was known as the Roaring Twenties. However, as consumer spending started to rise and speculation couldn't really justify the future earning potential for a lot of these publicly traded companies, the first domino fell. As on October 24th, 1929, investors sold a record 12.9 million shares that were already overvalued to begin with. History would title this day as Black Thursday, and it's one of the most impactful and significant days in the history of our nation's economy. But of course, just 5 days later, a new record of 16 million shares would be sold in panic on what we now call Black Tuesday. And this massive crash in the stock market would eventually trickle to other parts of the economy as consumer confidence would plummet, which led to businesses failing. And with businesses failing, millions of Americans lost their jobs, wages for existing jobs fell, and overall buying power decreased. Eventually, this would result in mass unemployment, homelessness, and household financials at an all-time low. So fast forward to today, 2022, where the stock market is arguably more overvalued than it's ever been, being propped up by trillions of dollars of printing by the Federal Reserve, reckless government spending, which includes trillions of dollars in the form of stimulus checks, which I'm sure didn't go to any unnecessary luxury items, along with inflation being at an all-time high and many public companies being traded on the stock market having their value be artificially inflated by record cheap debt. In fact, looking specifically at tech companies, a scary example in fact is that currently 65% of all public tech companies in the Silicon Valley Greater Bay Area are currently losing money, yet somehow are still billions of dollars overvalued in what they're worth. Now, of course, just judging by what we're seeing in the stock market, it's very easy to conclude that we're headed towards a pretty nasty economic crash. But obviously there's life still outside of Wall Street, and of course the big question still remains. Are we headed for an everything crash? So in this video, I'll be going over 3 major things happening right now that are outside of the stock market that I believe will help us answer this exact question. With that said, let's begin with the first major event that I believe will have the most impact on a potential everything crash, which is the increasing likelihood of the housing market crashing over the next 12 to 18 months. Now, we all know that the housing market has been the hottest it's ever been, with consecutive records for the median sales price in the United States. Between record low interest rates, excess money printing, and inventory being pushed low, we saw a lot of Americans paying more than the asking price for homes on the market. However, it seems that the tide is beginning to turn the other way.
Well, well, well. How the turntables.
Because if we really want to see the realities of the housing market, we have to look at the overall supply and demand. In fact, starting with the supply side, we can see that there are still large amounts of shadow inventory in the housing market, meaning that these are homes purposely kept off the market through situations such as banks holding onto that inventory, or in recent case, the foreclosure moratorium. Which, stating an article from Eviction Lab, despite the severe economic repercussions of the COVID-19 pandemic, we estimate that over 3 million eviction cases have been avoided nationwide between March 15, 2020 and the end of 2021. Now, obviously, not all of those 3 million cases would involve homes re-entering into public inventory. However, according to another article by Eviction Lab, the US saw at least 1.55 million fewer eviction filings than normal. And also, if you look at this chart, which shows national housing inventory, we can see that before the pandemic, we were always at least above 1 million homes available in inventory. Yet, in April 2022, that number was only 409,473. So imagine if even only half of that 1.55 million homes were to enter into public inventory. I mean, you're talking about a totally different housing market at that point. In fact, we're already starting to see this happen, as over the last 12 months we've seen foreclosure filings increase 160%. But what's even crazier is that even without that, we're already starting to see inventory in certain parts of the country skyrocketing. For example, in markets such as Salt Lake City and San Jose, we're seeing around a 55% increase in inventory gains. So with that said, let's look at demand, because not only is supply increasing, but we're seeing demand in the form of consumer purchasing power and affordability and financing starting to fade as well. In fact, mortgage rates increased for the 9th time in 10 weeks, and even comparing mortgage rates now to this time last year, the 30-year rate is up 2.36%, meaning it almost doubled in just the last 12 months. And well, considering that my wife and I actually got quoted for a mortgage rate of 5.1%, which 3 months ago, that was closer to 3%, which is ridiculous. Adding on to that, according to CNBC, wage growth actually went down 1.7% in consideration to inflation. And on top of all of this, we haven't even talked about the Federal Reserve, considering that they just increased their lending rate by 50 basis points, which is the largest that they've done in 20 years. Now, keep in mind that it usually takes about 6 months for the real estate market to catch up to what the Fed usually does. So here's my prediction, is that a lot of what we're talking about right now is actually going to be realized by the masses within that time frame. Now, of course, the housing market is something that's talked about anywhere and everywhere. However, this next major event is something that isn't really talked about all that much, if not at all. But yet, I believe it will still have major significant consequences. And that, my friends, is a huge credit card bubble that's just about ready to pop. In fact, in an article published on CNBC, we now have the highest amount of credit card debt in the history of our country, with a grand total of $930 billion. Which, keep in mind, right before the great crash of 2008, the total amount of credit card debt was $870 billion, and we actually surpassed that number 2 quarters ago. But what the scariest part is that the younger Americans, classified as those between the ages of 18 to 29, actually have the highest delinquency rate, with a rate of 76% higher than any other age group. And with all this debt accumulating, if the rate on these cards were to increase, it would cause severe consequences, with one of those consequences being consumer spending plummeting significantly. And of course, at this point, we begin to see a scenario where our credit cards get maxed out, our wages and income don't increase, but our prices continue to do so because of inflation. And yes, I know the Fed raised rates to be able to fight that inflation, but in my opinion, it's a bit too late, as inflation is still reported to be above 8%. But of course, between me and you, we all know that the real inflation number could be as high as 20%. Thanks, Joe. But all in all, we could be seeing a scenario where Americans cannot make payments anymore on all of these expenses. And well, from then on, it's Armageddon. Now, with that said, the last and final major event is a rather short one. But it doesn't really take much research and data to figure out that government spending isn't likely to slow down anytime soon, especially with everything that's happening around the world. In fact, we're expected to spend another $40 billion towards the Ukraine aid package, of which the voting will happen tomorrow, considering the time of this recording. So with that being said, let's take some inventory on everything that's happening right now from a 30,000-foot view standpoint. And this is a combination of my own personal experience, my observation of what's happening in the marketplace, and all the research and data that I've been accumulating the last 3 to 6 months. Number one, the housing market is expected to see a big correction over the next 12 to 18 months. Number two, the stock market, as we discussed in the beginning of the video, will also take a big hit. Number three, consumer spending will decrease and our economy will not be as strong regardless of what big media will say. And most importantly, number four, we are still in more debt than ever before, considering that our US deficit is still above $30 trillion. And arguably the scariest part to all this is that the national household debt is now nearing $16 trillion, even despite rising interest rates, record highs in home equity, and inflation. So of course, the question still remains, are we in an everything bubble? My answer, yes. Thanks, Joe. So obviously a lot of what we just talked about in this video is going to be affected tremendously by what happens with Russia and Ukraine. And well, it just so happened that a couple days ago, my brother released a video on what's happening right now with the Russia-Ukraine crisis. So go ahead and click on that link in the end screen right now and check out that video. And with that said, guys, thank you so much for watching. Like this video, subscribe, and I'll see you guys in the next one.